Most likely, IAS 12 income taxes will be tested by giving you a scenario where there have been some tax losses. And the question is whether deferred tax asset can be recognized or not. In this very case, you are going to challenge the scenario, so take the examples from it and explain. So, for example, if the company has suffered losses for several years already, then you would say that it may be quite unlikely that the company will be able to earn profits. If you are given numbers, then you should challenge the numbers. If the company has prepared the budget, you will need to make sure that it's not over-optimistic. So on a normal day, the budget should include only 5 years, and then the rest is going to be just extrapolated, taking stable, declining, or zero growth rate. So if your scenario talks about some optimistic budgets for 10 years or something like that, you need to explain that this is over-optimistic. It can't be used for IAS 12, under IAS 12, as the basis for deferred tax asset recognition justification. Then we need to remember where the other side of the story will go. So let's say deferred tax liability is going to be recognized when there is an acquisition, credit deferred tax liability. At the acquisition date, there is going to be goodwill increase, debit goodwill. Why? Well, because most likely the acquisition will require you to have positive fair value adjustments because there will be more assets fair value adjustment rather than the recognition of fair value of liabilities, like, let's say, contingent liabilities. Now, then, all of the following recalculations are going to be charged to P&L. So, for example, if there was depreciation that was charged on the fair value adjustment at acquisition, then this means that deferred tax liability is going to be reduced. And the difference between the new deferred tax liability and the reporting date and the deferred tax liability recognized at acquisition date will go to P&L. If deferred tax would relate to something that would be recorded in OCI, like revaluation of IAS 16, you need to make sure that you stress that this is recorded in OCI as well. And as such, sometimes you will have several effects. Part of the effect will go to OCI, part of the effect will go to P&L. You need to make sure that you split those. And finally, quite often we are tested on the tax rate that would be applied. And that should be the rate that will be applicable when the asset is realized or the liability is settled. So this means that if the government is planning to increase the tax rate from 20 to 30%, you will need to look at the year when the asset is going to be realized and apply the rate that will be used that year. But we take the tax rates that have been enacted by the reporting date. So if this legislation was issued after the reporting date, it's non-adjusting. Yes, this will be the criticism of IAS 12 of IAS 10, IAS 12, because actually adjusting events are something that relate to the state of the asset or liability at the end of the year, and these are the assets that will be recognized in future, that will be realized in future, or liabilities that will be realized in future, and the change in the future tax rate looks like a adjusting event, but it is not. So this is how IAS 12 most likely will be tested. And of course, there are other more complicated topics like, let's say, IAS 12 and deferred tax on leases. But make sure that you know at least how to take the low-hanging fruit first.